In late 2026, the United Kingdom was running out of money. Citizens were trapped in a severe cost of living crisis, and Prime Minister Andy Burnham faced a massive budget deficit ahead of his October tax plans. But that financial pain was not shared equally. During the first 6 months of that same year, Britain's big four banks, HSBC, NatWest, Barclays and Lloyds, recorded £29.2 billion in combined profits. Here is exactly how those profits materialized. The banks didn't invent a highly demanded new service. Instead, as the Bank of England raised base interest rates to fight inflation, commercial bank profit margins mechanically expanded. They charged more for loans while keeping deposit payouts low. This created an incredibly lucrative anomaly. Billions of pounds generated passively, sitting directly in the path of a sovereign government desperate for tax revenue. Campaign groups like Positive Money quickly did the math. They proposed a highly targeted 38% windfall tax designed to pull £19 billion straight out of those specific domestic profits. For the Burnham administration, this single levy could solve their immediate fiscal nightmare, funding an entire nationwide package of social relief overnight. The banking industry immediately returned fire, warning that any attempt to seize those profits would result in severe economic retaliation against the City of London. The industry's primary weapon is capital mobility. Unlike a physical auto plant or domestic retail chain, hypermobile financial institutions can reroute operations, data, and wealth across borders in seconds if they decide a tax environment is hostile. This established the ultimate standoff. The UK government holds the legal authority to draft the tax code, but the global banking sector holds the structural power to punish them for using it. To understand the government's leverage, look at the sheer scale of that £19 billion. This chart juxtaposes potential revenue against Burnham's relief programs. A £19 billion windfall tax covers proposed electricity VAT cuts and bus fare caps 13 times over. Despite arguments for operational stability, £13.7 billion bypassed emergency reserves, flowing directly into shareholder stock buybacks and dividends. The public coalition's leverage relies on undeniable math. The wealth exists. It is not being reinvested into the real economy to build infrastructure or fund new businesses, and it is large enough to instantly balance the government's books. But the banking lobby has its own math, centered on the argument that they are already heavily taxed. This visualization breaks down the tax landscape for UK financial institutions. Between the 25% corporation tax, a 3% surcharge, and balance sheet levies, UK banks face a 46.6% effective rate. For comparison, New York banks face 28%, and Frankfurt sits at 39%. That gap gives executives like JP Morgan CEO Jamie Dimon a clear line of attack. He personally warned Chancellor John Healey that adding another layer of taxation would force his firm to relocate high-paying finance roles to cheaper jurisdictions. Dimon wasn't making an empty threat. He explicitly pointed to JP Morgan's pending £3 billion headquarters project in Canary Wharf and the 400,000 jobs attached to the broader UK finance sector as the ultimate collateral damage in this fight. Even if banks stay in London, they have a secondary mechanism called the pass-through effect. The International Monetary Fund documented that when governments levy heavy taxes, banks simply offset the cost by raising mortgage rates and loan fees on consumers. It is an almost perfect structural trap. If the government taxes the banks, the executives either take their capital and leave the country, or they stay and force the working public to pay the bill anyway. The October 2026 budget quickly evolved from a standard fiscal update into a zero-sum test of Andy Burnham's government. If the Prime Minister pushes the windfall tax through, he risks triggering a capital exodus that hollows out the City of London and sabotages his own long-term economic growth plans. But if he backs down, he publicly confirms that global financial institutions have grown so massive and so mobile that they hold de facto veto power over national tax policy. Economists call this the golden goose paradox. A nation builds its economy by relying heavily on a single, hyper-profitable sector, only to realize the government is now paralyzed from regulating it because the broader economy would collapse if the sector left. It leaves the UK facing a difficult reality. There is no point in housing a golden goose in your capital city if your sovereign government is no longer allowed to collect the eggs.